Sapura Energy Berhad is an integrated oilfield services company based in Seri Kembangan, Selangor and is a public limited liability company. This group was formerly known as Sapura Kencana Petroleum Berhad through the merge between Sapura Kris and Kencana in May 2012. Sapura Kencana Petroleum Berhad was renamed as Sapura Energy Berhad on 2017. Sapura Energy provides solutions covering the entire oil explorations and production value chain. Among Sapura Energy core businesses are engineering, constructions, operations and maintenance of the oil and gas industry as well as drilling. The group employs approximately 30,000 people and operates in more than 20 countries, including Malaysia, Brazil, the United States, West Africa and the Middle East. It trades on the Bursa Malaysia main market and Sapura Energy Berhad is now a PN17 company. Sapura Energy vision is to be the best global oil and gas company led by entrepreneurs technically competent and the most trusted in the eyes of customers, shareholders, and most importantly, the people they empower. They will be guided by their honesty, trust, and respect for all. They will achieve their business objectives safely, efficiently, and professionally, continue to strive to meet all the expectations of their stakeholders.
Now I will be starting off for the financial performance review in the current ratio. So current ratio can determine how liquid is the organization by comparing firm's current assets with current liabilities. The simple definition for the current ratio is used to measure a company's ability to pay short-term obligations by calculating together with inventory. Sapura Energy have the liquidity at the highest in the year 2018, which has a current ratio of 1.02 compared to other years. So, whenever the current ratio is greater than 1.0, it indicates that the company has the financial resources to remain solvent in the short term. However, when the company have lesser current ratio than 1.0, indicates that the company does not have the capital on hand to meet its short-term obligations if they were all due at once. Next, we will take a look of quick ratio. Quick ratio also can determine the liquidity of the organization by comparing firm's current assets with current liabilities. The simple definition of quick ratio is to assess a company's capacity to satisfy its short-term obligations using its most liquid assets and serve as an indicator of its short-term liquidity position. It is also known as acid test ratio. Sapura Energy has the most liquid in the year 2019, which has RM1.31 for every RM1 in current debt compared to other years. From this data, we can conclude that whenever the quick ratio is greater than 1.0, it indicates that the company has sufficient liquid assets to satisfy its short-term obligations. However, whenever the company have lesser quick ratio than 1.0 indicates that the company has insufficient quick assets to meet their financial obligations in the event of a financial crisis.
We also use average collection period in this question. The average collection periods measure how long it typically takes a company to collect and turn its account receivable into cash. Sapura Energy have 116 days in collecting account receivable and it is the fastest compared to other years. 152.2 days for the year 2017, 154.5 days for the year 2018, 218 days for the year 2021, and 222 days for the year 2019. And can consider as the slowest in collecting account receivable. A longer average collection period means the company has less liquidity. A shorter average collection period for 116 days, for example, is generally preferable and means a company has higher liquidity. We also use inventory turnover ratio. Inventory turnover is a financial ratio that displays the frequency with which a company inventory is changed in relation to its cost of goods sold over a specific time period. Sapura Energy moved inventory the fastest at 18.08 times for the year 2020, 13.08 times for the year 2018, 12.99 times for the year 2017, 12.24 times for the year 2019, and 11.18 times for the year 2021 considered as the slowest. A higher ratio tends to point to strong sale and a lower one to weak sale. Conversely, a higher ratio can indicate insufficient inventory on hand. and a lower one can indicate too much inventory in stock. A lower inventory turnover ratio might be a sign of weak sale or excessive inventory, also known as overstocking.
Section 2, the managers are generating and educate operating profit on the organization asset. We use total asset turnover ratio to answer this question. The asset turnover ratio determines net sale of the company as a percentage of its assets to establish the amount of revenue realized from each dollar of its assets. This ratio indicates how efficiently a firm is using its assets in generating sales. For the data, the total asset turnover ratio in 2017 was 20 cents, 2018 was 19 cents, 2019 was 40 cents, 2020 was 28 cents, and 2021 was 24 cents. In all years, the ratio is less than 1. Is not good for the company as the total assets cannot produce enough revenue at the end of the year. A higher ratio was 28 cents in 2020 tends to point using its assets more efficiently in generating sales, which is a major determinant in the firm's operating income return on investment. A low ratio was 40 cents in 2019 may be a sign of weak managed assets in generating sales. Next, we use fixed asset turnover ratio. Fixed asset turnover is an efficiency ratio that indicates how well or efficiently a business uses fixed asset to generate sales. This ratio measures how efficiently a company is generating net sales from its fixed asset investment. From the data, the fixed asset turnover ratio in 2017 was 0.10%. In 2018, it was 0.38 cents. In 2019, it was 0.46 cents. In 2020, it was 0.76 cents. And in 2021, it was 0.58 cents. The higher the fixed asset turnover ratio, the more effective the company's investment in fixed assets have become. A higher ratio was 0.67 cents in 2020. A high ratio indicates that companies spend less money in fixed assets for each dollar of sale revenue. A low ratio of 0.10 cents in 2019 indicates that a company is overinvested in fixed assets. Next, we also use return of asset ratio to answer this question. Return of asset is a financial ratio that indicates how profitable a company is in relation to its total assets. ROA used to determine how efficiently a company uses its assets to generate a profit. From the data, the return on assets in 2017 was 0.55%, 2018 was 8.35%, 2019 was 0.61%, 2020 was 20.07%, and 2020 was 0.71%. A ROA of over 5% is generally considered good and over 20% is excellent. A higher ratio was 20.07% in 2020. It indicates a company is good at converting its investment into profits. A low ratio was 0.55% in 2017. It indicates that the company is not able to make maximum use of its assets to get more profits. Operating profit margin ratio is also used to answer this question. Operating profit margin is a profitable or performance ratio that reflects the percentage of profits a company produces from its operations before subtracting tax and interest charge. From the data, operating profit margin ratio in 2017 was 2.69%, 2018 was 42.49%, 2019 was 4.45%, 2020 was 70.78%, and 2020 was 29.97%. As a rule, 5% is a low margin, 10% is a healthy margin, and 20% is a high margin. A higher ratio was 70.78% in 2020. A high operating margin is a good indicator a company is being well managed and its potential less of a risk. A low ratio was 2.69% in 2017 and 2021. It indicates managers were not as good at managing the cost of goods sold and operating expenses as they were in 2020.
In the question 3, how is your organization financing its asset? We use time interest and ratio. The time interest and ratio measure a company's ability to service its interest expense obligation based on its current operating income. Sapura Energy operating income is 2561 times the annual interest expense and is considered as the highest in the year 2020 compared to 1731 times in the year 2018, 179 times in year 2019, 96 times in the year 2019 and 51 times in the year 2021. 2561 times considered as the highest and indicate to investor that the company is over risk averse. The higher the time interest and ratio, the better the company at paying the interest. A lower time interest and ratio means fewer earnings are available to meet interest payment. Failing to meet this obligation could force a company into bankruptcy. In this question, we also use debt ratio. Debt ratio refers to a financial ratio that assesses how much leverage a business has. The ratio of total debt to total asset, represented as a decimal or percentage, is known as the debt ratio. Sapura Energy, the company, financed 54% of its asset and 46% by equity, and it is considered as the highest compared to other years. A higher debt ratio, which is 60% and higher, makes the company more difficult to borrow money. Lenders often have debt ratio limit and do not extend further credit to firms that are overloaded. Lower ratio debt, 40% of its assets, are considered better debt ratio since the interest on a debt must be paid regardless of business profitability. Question 4. Are the manager generating a good return of equity? We use return on equity to answer this question. Return on equity is a metric of financial performance obtained by dividing net income by shareholder equity, and also referred to as the return on asset since shareholder equity is determined by subtracting a company debt from its asset. Sapura Energy will receive the highest return of 1.79% in the year 2021 compared to 1.58% in the year 2017, 1.47% in the year 2019, 0.50% in the year 2020, and 0.27% in the year 2018. One of the reasons for higher return of equity is the higher operating return on asset generated by Sapura Energy, which is positive 0.7%. A higher return on the firm asset will always result in a higher return on equity and vice versa. Also, Sapura Energy use high debt, which is 46%. Higher debt translated to higher ROE under favorable company condition.
Market share is a key indicator of company's competitiveness. When a company increases its market share, this can improve its profitability. This is because as company increase in size, they too can scale, therefore offering lower price and limiting their competitors' growth. In some cases, companies may go so far as operating at a loss in some division in order to push out the competitors or force them into bankruptcy. Business trust is a new asset class introduced in the Malaysian capital market following the release of the Securities Commission Malaysia's Business Trust Guidelines, which came into force on 28 December 2012. Business trusts are business enterprises set up as trusts instead of companies. Production disruption is the issues that lead to Sapura Energy Company being listed PN17. All of this connected to the COVID-19 pandemic, which has ravaged our nation. As a result, there are a lot of manual withdrawals, computations involving money that has already expired, and balance sheets. The company currently negotiating with its vendors on unpaid invoices as well as with with lender via current or new facilities and under a plan of arrangement. The fundamentals of the group are still weak and much more rehabilitation is required, notwithstanding recent public rumors about the possibility of financial aid from multiple parties by investor sentiment. Bursa Malaysia Securities, which runs the local stock exchange, has classified Malaysia's cash-strapped Sapura Energy as being under the Practice Note 17 category and is therefore selling off assets to help keep it afloat. As its 85 million ringgit shareholders' equity on a consolidated basis is currently less than 50% of its 10.9 billion ringgit share capital.
Next, I will move to projection and recommendation. Based on what you know about the organization financial health and performance, forecast its future performance. Business forecasting is making educated assumptions about specific company measures such as sales growth or forecast for the company as a whole. Financial and operational choices are based on current economic condition and the unpredictable future. For Sapura Energy Berhad, there are three forecasts for the future performance. Firstly, Sapura Energy Berhad will getting more efficient. Sapura Energy Berhad is doing well in the return on equity, which the highest return is in 2021. The percentage of ROE will increase from 0.5% in 2022 to 1.79% in 2021. The higher a company ROE percentage, the better. It indicates Sapura Energy Berhad is more effective at generating profit from its existing asset. That is, the company getting more efficient in the future. A company that generates a healthy ROE often has self-funding and will require no additional debt or equity investment, either of which could decrease the shareholder value. A very high ROE is advantageous if net income is extraordinarily high relative to equity because it shows that the company is performing well. Secondly, they might struggle to meet its short-term obligation. For the Sapura Energy Berhad, the current ratio in 2021 is RM 0.65 and the amount is less than RM 1.02 in 2018. In many cases, a company with a current ratio of less than 1 does not have the capital on hand to meet its short-term obligation if they were all due at once. If their current ratio is greater than 1, it indicates that the company has the financial resources to remain solvent in the short term. For future performance, if the current ratio remains constant, Sapura Energy Berhad might struggle to meet its short-term obligation. In theory, the higher the current ratio, the more capable a company is of paying its obligation because it has a larger proportion of short-term asset value relative to the value of its short-term liabilities. Lastly, Sapura Energy Berhad might face bankruptcy. For the times interest earned, it shows that Sapura Energy Berhad has much higher risk for bankruptcy or default in future if the number of times interest earned is low and remain constant. This is because less earnings are available to cover interest payment when the time interest earned ratio is lower. A business may become bankrupt if these responsibilities are not met. Lenders and borrowers both use it to assess a company's debt capability. Let's move to the recommendation to improve financial health. When a company is announced as a PN17 company, Sapura Energy Berhad needs to improve the financial health and performance so that it is no longer considered a PN17 company. Sapura Energy Berhad needs to improve the debtor collection. The likelihood of fewer sales increase the delay rate of receivable collection. This lowers the ratio of asset turnover. The corporation can genuinely raise the asset turnover ratio by creating and strictly enforcing a debtor policy. This can be accomplished by employing a collection firm to handle the process of collecting, hiring a worker to manage accounts receivable, or shortening the debtor credit period to at least industry standard. Besides, by improving their revenue. Improving revenue is the easiest way to a healthy asset turnover ratio. The company must effectively shift its stock and conduct advertising-based marketing campaign to determine whether a slow-moving product is kept as the warehouse. The company can also inspect it. Last but not least, Sapura Energy Berhad need to go through a few exercises to meet Bursa requirement. They must complete the implementation of approved regularization plan and submit an application and necessary document to Bursa to prove that it's no longer a PN17 company. In order to meet the requirement, the PN17 issuer and its recognized principal advisor must persuade the exchange that the regularization plan will strengthen the PN17 issuer financial position, including the equity, gearing, net asset position, cash flow position, and ability to address its accumulated losses position. In order for the PN17 issuer to no longer trigger any of the prescribed criteria upon execution of the regularization plan and not trigger any of the prescribed criteria in the near future, the steps taken or proposed to be taken are extensive and proficient of addressing the issues that had caused the PN17 issuer to trigger the prescribed criteria.